He studied himself and developed uh, his own laws, principles, and technique to trade the markets, price action, and the volumes that we have now. So there were no such thing, but if you look, you will understand there were tips, small tips, those were generated, and weak hands within this sharp down move, and then we get a strong automatic rally and again falling back to have a secondary test of the selling climax. Checkout type mechanism, and also it creates a fear within the weak hands, and the stop losses are also hit within this mechanism, and again we enter into a test of this spring. See the volumes are dropping significantly as we pass on from the phases of A, B, and into C. This was the trading range that we saw in previous chart as well, and we can call this whole trading range as a causality, and that is nothing but the result that has been generated due to the effort that has been applied to generate this result. You see how there is sharpness in the fall that has increasing gap down, the increase of welcome to my channel of contextual trading. So today we are going to look into the introduction part, and also have the understanding of what exactly is the methodology that we are going to learn under the contextual trading. And yeah, let's get started. So quick disclaimer: all the opinions expressed in this channel are only for informational and educational purpose. Please do not consider them as a buy or sell recommendations. Okay, so in order to understand what exactly we are going to cover under contextual trading, I prefer to answer few of the questions. Okay, so let's start. So first is understanding of existing conventional trading methods. Okay, so as we all know, already there are existing some conventional trading methods, like first is use of technical indicators, RSI, MACD, Bollinger Bands. Then we also know there is use of technical patterns like flag pattern, head and shoulder, inverse head and shoulders, W shape, etc, etc. And there are also traders who use only the price actions. They use only price action to trade, and even there are traders who use only breakout or breakdowns for trading. Okay, so these are the conventional trading methods, and alongside of these we also know there are few theories that most of them also use, like Dove theory is there, Elliott wave theory, Gann theory, and time cycle theory. Okay, so all of these I think they are the existing methods, conventional trading methods. And what we are going to see under contextual trading are two major topics. One is Wyckoff methodology. Richard D. Wyckoff, who developed this technique of understanding the markets, reading the markets, and trading them. And second is VSA, also known as volume price analysis, also sometimes called as VPA, if I am correct. So these are the two major topics that we are going to learn, and in the coming slides we are also going to see how it is different than the conventional trading methods that are existing. Okay, so not that these methods do not make you a profitable trader, but it is just that I find that these conventional trading methods don't have some strong or solid foundations required to trade the markets. Okay, of course there are traders who have developed expertise and experience using these methods, and they are earning good or having good profits. Okay, but it is my understanding that for example, if we take the technical indicators, so these technical indicators are what we can say are the derivatives of price, because these are generated after the price action is generated. Okay, and usually they are also known as lagging indicators. So what we are here is to have understanding of or something that is going to help us to forecast the future price action. But these existing technical indicators, they really don't help to forecast the future price behavior. Okay, while if we talk about the flag pattern or head and shoulders or W shape or the patterns, so these are just the shapes that are generated on the charts. And what has exactly happened is people have developed using probability and statistics. Using probability and statistics, they have developed the methods or the behavior of the price behavior once these kind of shapes or patterns are developed. So whether it be flag pattern, so breakout of flag, or whether it be head and shoulders, so based on their experience, people have generated the theories and concepts using pattern and to trade them. Of course, they have developed the experience and expertise as well to be profitable out of them, but they really don't have some sound fundamentals. They really don't define whether the dominating force is supply or demand, or they really don't indicate us whether this is under accumulation or these are under distributions, and so on and so forth. Okay, so we are going to look into this all these topics. As we move on, we are going to understand who exactly was Richard D. Wyckoff, what was his methodology, and yes, let's move on. Okay, so who was Richard D. Wyckoff? Richard D. Wyckoff was early 20th century pioneer in technical approach to studying the stock market. Okay, he was also amongst the five titans of stock market. So others were Dow, Elliott, Gahn, and I think one more. So he was amongst them. uh, Wyckoff was also a avid student of market as well as an active tape reader. Okay, so what exactly is tape reading? So we are going to see this in the next slide. What exactly is the concept of what exactly we mean by tape reading? Okay, and of course he was very curious about the markets, identifying the exact underlying trends and underlying logic behind the markets, why it is happening, what are the reasons of the behavior of the prices, and so on and so forth. Okay, and Wyckoff also had conversations, interviews, and observations with big traders at those times, Jesse Livermore, JP Morgan. So these were the big players or the operators. He observed them carefully, and he studied himself and developed uh, his own laws, principles, and technique to trade the markets using the method or using the observations and studies that he had while alongside with these big operators. Okay, and also yes, he derived a term called as composite operator. So we are going to see even this, who exactly is a composite operator, what does he mean by composite operator or composite man. Okay, composite man. And also he provided or offered a detailed analysis of trading range. So we are going to see some examples of detailed analysis of trading ranges. Okay, And yes, let's move on. So okay, so who is a composite man? So Wyckoff looked at this market activity as a group of large investors and traders that influence the price structure in a big way. Okay, so in today's times we can take example of Warren Buffett, BlackRock, and etc. So these big investors and traders can be banks, they can be financial institutions, they can be insurance companies, pension funds, hedge funds, etc. Okay, so these people have huge amount of money. Okay, so yes, so this huge amount of money is definitely going to have an impact on the price structure. Okay, and the requirements and the ways of trading of these huge institutions is completely different than what ordinary retail trading is. Okay, and when all of these institutions are conducting the campaigns, so they conduct their campaigns either to accumulate stock or to distribute the stock. Definitely they tend to be the big force behind the buying and selling in the markets. Okay, and that's what moves the prices higher or lower. Okay, so altogether this Wyckoff, altogether Wyckoff called them as a composite man. So it is just a theoretical term, I will say. Composite man who sits in the behind the scenes and manipulates the stock. Okay, so here you can see a composite man who in theory sits behind the scenes and manipulate the stocks. So it is just a theoretical term derived by him, and what basically he means is the big players who have huge amount of money, who have the ability to move the prices higher or move the prices lower, they are termed as a composite man. Okay, or an composite operator. Okay, so next is tape reading. So what exactly is meant by tape reading? So if you go back and have understanding of those times, you will realize that there were no charts in those times like we do have now. So there were no price action and the volumes that we have now. So there were no such thing, but if you look you will understand there were tapes, small tapes, those were generated, and there was printed information of the price and the volume that was traded. So during those times they were able to read those tapes and understand what exactly is the dominant force, whether it is supply or demand, and they used to study them during those time. Okay, so it was tape reading during those time, and for us now it is chart reading. Okay, and you can go through all these points what exactly is meant by tape reading. So we are quickly going to summarize here. So it is the science of determining from the tape the immediate trend of the prices. For us now it is going to be charts. Okay, so it is the science of determining from the charts the immediate trend of the prices, and it is a method of forecasting from what appears on the tape now what is likely to appear in the future. Okay, and also to understand whether the stocks are being accumulated or distributed, or the prices are being marked up or marked down, so or are they being neglected by the larger interest. So these all account to the science of tape reading, or we can say chart reading for us at the moment. Okay, and we are going to see all this in next slide with the help of some examples on the charts. Okay, so this is the first example of chart trading of an accumulation structure. So yes, as we see, this is a complete detailed analysis of trading range as Wyckoff studied. So this is a complete trading range and its detailed analysis. So we see, first we see there are multiple phases: phase A, phase B, phase C, phase D and E. So total 5 phases, and each of these phases have some intention. There is intention behind each phase, and action associated with that particular intentions. So starting from here, so first we see preliminary support, which is also called as PS in nomenclature. So we know this is the first point where the big money has entered and they have started to buy the stock. Continuing downwards, we see there is selling climax. So this is the climatic move, we can say. You see how there is a capitulation of the weak hands within this sharp down move, and then we get a strong automatic rally and again falling back to have a secondary test of the selling climax. Okay, so the phase A is associated with the stopping action. Okay, the intention here is the stopping action, stopping of the stock from falling downtrend and then entering it into a non-trading environment, non-trending environment, sorry. So as we enter in phase B, we see there is interaction of supply and demand. So here we have an upthrust action in phase B. Upthrust is nothing but temporary commitment of the prices above the trading range and quickly falling back in the trading range. Okay, and moving in phase C, we get to see a strong spring type action where the stock goes below the trading range and immediately bounces back within the trading range. So this kind of creates what we can say is um, a shakeout type mechanism, and also it creates a fear within the weak hands, and the stop losses are also hit within this mechanism, and again we enter into a test of this spring. Okay, a higher low test, and we continue uh, entering in phase D. Okay, so here what we see is a nice sign of strength beginning from the lower end of the trading range and entering in the higher range of the trading range. Here we spend some time, which is nothing but what we can say is absorption of supply, where the last supply is been absorbed at the top of the trading range, which is also known as the backing up action, or it can also be called as LPS. So yes, here also we have an LPS. We spend some time here, which is LPS stands for last point of support. So basically this is the point from which the stock never falls back, or this is the last point, we can say, where the stock never retraces back. Okay, and SOS is a sign of strength, as I mentioned earlier. Okay, so this is the backing up action, which is in phase D, and once the phase D is completed, we enter in phase E, which is nothing but the bullish phase of the stock. Okay, so bullish phase, since we have accumulation here, and similarly bearish phase in phase E, if we have distribution. And see how the volumes are developing. You see the volumes are dropping significantly as we pass on from the phases of A, B and into C, and as we enter in phase D, we see there is increase in the demand, how operators have started to mark the prices up. Increase of demand, increase of prices, and the characteristics, the behavior of the movement of the prices compared to previous previous behaviors is completely different and can be seen as a strong move. Okay, so this is just outlook, I can say, or a schematic of accumulation, basic schematic of accumulation. And of course we are going to deep dive into each phases going forward. We are going to see each term in detail, what it means and what is the purpose and the action, the test that happen over the period of over the trading range. And eventually based on our observations, we are going to deduce or conclude what is exactly likely to unfold in the near future. Okay, so this is just one example of accumulation structure. um, let's move forward. So next we have here on the next slide is are the fundamental laws of Wyckoff methodology. I deliberately kept this slide after accumulation structure so that you can have a little bit of understanding exactly what and how these laws come into play, or what they mean exactly. So the first law here is about the supply and demand. So supply and demand is nothing but having the interaction of supply and demand and identifying which is the dominant force across the trading range. Okay, to understand which force is stronger, is it the supply that is being dominant or demand that is being dominant? Are the operators selling, or are they accumulating and buying the stocks? Okay, so this is the meaning of first law of Wyckoff. Second is the law of cause and effect. So whatever the trading range that we saw, so this was the trading range that we saw in previous chart as well, and we can call this whole trading range as a causality. So this is the cause, and whatever we are going to get the result of this cause is nothing but what we can say is the effect. So what I can say is it is quite a directly proportional relation, we can say, where the bigger is the cause, the bigger is going to be your effect, and it is going to be same in both the cases. Okay, and there is a method to determine this, specifically cause and effect. There is a method to determine the targets of how much the stock is going to rally after the particular causality is finished. So that method is nothing but P and F, which is also known as point and figure. Okay, so it is a complete different study, and it is just associated with the Wyckoff, and one can be able to determine the targets of particular charts. Okay, the next law is effort versus result. So what effort versus result basically means is in simple terms to say, volume here stands for effort, and the price action what we see is nothing but the result that we are going to get. Okay, so volume here stands for effort, and the price action is our result. So in this case I'm showcasing one example here. So if we see that this much amount of effort is applied to push the prices higher, and so are these prices moving, and what is the distance that the prices have moved, and that is nothing but the result that has been generated due to the effort that has been applied to generate this result. So let's take another example to understand it better. So here also if you see, so here we see a large effort has been applied. Okay, but in this case if you see, the result that we are getting is not as significant as this. Okay, so in this scenario the result and the effort were quite the same, we can say. Okay, but whereas here we see a kind of anomaly where your effort is more, your effort is very high, but the result is very less. Okay, so this indicates there is increase in supply, there is increase in the opposing force, due to which the effort uh, is lacking to create the supply that sorry, the effort is lacking to create the result that is been needed. Okay, and this is just example how we are going to read the volume versus the price action. Okay, so these volumes are nothing but the efforts that are being used to generate the results, and we have to understand the relationship between these volumes and the prices. Okay, so this is the third law of Wyckoff. Last moving to the next slide, we have one more example of chart reading, and we have a distributional example. So here also similarly, if we see, we have multiple phases A, B, C and D. So E is into E is yet to unfold. So you see how nice climatic up move here we are getting into the buying climax. So all the weak hands are trying to find the value, whereas the operator has already started to sell in this area, and you see we get a nice automatic reaction to this climatic move and a secondary test of the buying climax. So this eventually concludes our up move, and the stock is now ready to move in a non-trending environment. Okay, and this concludes the phase A. Entering in phase B, so here also we have multiple nomenclatures. We see upthrust action, secondary test, sign of weakness. So again, upthrust is temporary commitment above the trading range, and how see the characteristics, how the prices are immediately rejected, entering into the upper area of the trading range. Okay, and right from the upper range of trading range to straightway down in the lower area of the trading range, which forms to be the sign of weakness. Okay, and you see how the characteristics with which the stock is falling. There is increasing the volume, there is increasing the volume, there is increasing the volume, which indicates there is increase in the supply. Supply is increasing with each reaction that we are getting. Okay, and the characteristics is so strong that we are easily able to understand that operator is selling here. Okay, which is nothing but the distributional characteristics. As we enter in phase C, here we get upthrust action after distribution, so which is called as UTAT, because we have already concluded that we are under a distributional process, and we are getting an upthrust action in distribution. Okay, and yes, followed by a test. So here we can see a nice test, and this is the last point where I can see the stock is the highest price of the stock, and then the stock gets rejected sharply, and you see there is increase in the volume, which indicates there is increase in the supply again, that the operator is selling here. Okay, and where thereafter we enter in phase D. We see the stock with the weak hands trying to buy in these areas. Weak hands are still finding the demand, they feel that this is the value they are buying. The stock tries to move up, but the strong hand is unfortunately selling in these areas, and this creates exhaustion of the demand, and the stock is not able to cross this region, therefore creating the last point of supply. Okay, last point of supply. So this is similarly to the accumulation range, where we saw it was LPS, which was last point of support, and in case of distribution it is last point of supply. So the stock no more goes above this last LPS, and after LPS it just slides down easily. Okay, so this indicates that the operator is now getting more and more aggressive. You see how there is sharpness in the fall, that is increasing gap down, the increase of the price bar. You can see the increase of volume. So this suggests that the operator has almost finished his whole business of this trading range of selling, and now he is ready to completely empty his hand. Okay, so now we are entering into a last point of supply, which is potential last point of supply, and then again capitulation and in phase E. So this whole is again another example of distributional schematics. Okay, and again a detailed analysis of a trading range with the help of different phases, with the help of the price action and the volumes that are generated, with the help of analysis of the rallies and the reactions. So we are able to deduce, or with the help of observations, we are able to deduce what are the forecasting results that are going to come after formation of this trading range. Okay, so this is all about charting. We are going to see in depth the analysis of the stocks, or the accumulation and distribution trading ranges going forward. Okay, so I think this is it for today. Thank you so much for watching this video. Please do like, share and subscribe to my channel, and please comment below in the box if you have any points for discussion. Thank you and have a nice day.